Welcome to the Deep Dive. We take a stack of research and we just boil it down to the good stuff, just for you. I'm Mark,
Okay.
your host for this Deep Dive. And I'm joined by the insightful Anna.
Hi, everyone.
So, if you're digging our content and you want more financial deep dives, make sure you subscribe to the AI Finance Podcast YouTube channel.
Yeah.
And hey, if you're just looking to get rich quick with meme coins,
Yeah.
we got a link in the description that just might point you to the next 100x gem.
Absolutely.
But jokes aside, let's get serious about building wealth the smart way. Today, we're taking a deep dive into dividend stocks, specifically those companies known for consistent dividend growth. It's not just about chasing the highest yield. It's about finding those reliable companies that reward investors over the long haul.
Exactly. Consistent dividend growth can be a powerful signal of a company's stability and commitment to its shareholders. It's like they're saying, hey, we're doing well. We want you to share in our success. Especially in uncertain economic times, that kind of reliability can be a real game changer for your portfolio.
It really can. So we got some great sources lined up from Kiplinger and Morningstar,
Yeah.
both focused on dividend stocks, but with slightly different approaches.
Okay.
Kiplinger has this fantastic list of top dividend growers across multiple sectors, showing just how diverse the world of dividend investing can be.
What's fascinating here is that these companies aren't all clustered in one industry. You've got REITs, like realty income, which stand out because they pay dividends monthly. Now, that's a big deal for investors who rely on that steady stream of income to cover expenses or reinvest. Then you've got McCormick & Co., the spice giant, proving that flavor never goes out of style. They've been consistently growing their dividend for 38 years, showing how a company can thrive by focusing on a niche market and expanding strategically.
And then there's Caterpillar, a classic example of a cyclical stock, meaning their performance is closely tied to the ups and downs of the economy.
Right.
But even with those swings, they've maintained a 30-year streak of dividend growth, demonstrating their resilience and ability to weather different economic climates.
Exactly. What's key with Caterpillar is their strong market position and their focus on managing costs efficiently. That allows them to reward shareholders even when times get tough.
Absolutely. Kiplinger does a great job of providing these insightful company profiles, highlighting how each business achieves consistent growth and navigates its unique challenges.
Yeah, it's really interesting to see.
Now, Morningstar takes a slightly different approach. They're not just looking at dividend history. They're really emphasizing the importance of finding undervalued stocks with strong economic moats.
Right. An economic moat refers to a company's durable competitive advantages. It's what protects their profitability and market share over the long term. Think of it like a castle's moat. It keeps competitors at bay and allows the company to thrive.
I like that. That's a good analogy.
Morningstar argues that a high dividend yield alone isn't enough. You need that underlying strength and competitive advantage to ensure that the dividend is sustainable.
Okay, makes sense. So their top 10 list includes some interesting picks, like ExxonMobil.
Okay.
While some energy giants are transitioning towards renewables, ExxonMobil is doubling down on oil and gas.
That's right. It's a contrarian play. But Morningstar believes ExxonMobil's vast resources and operational efficiency could give them an edge in the current energy landscape.
Interesting.
They also highlight Altria, the tobacco giant, which has the highest yield on their list.
Now, it's important to acknowledge that the tobacco industry faces its own set of challenges.
Sure.
But despite those headwinds, Altria has consistently generated strong profits and rewarded shareholders. Their ability to navigate a complex regulatory environment and adapt to changing consumer preferences is a testament to their resilience.
Right. And then there's Medtronic, a medical device company with a wide economic moat, thanks to their diverse product portfolio, strong relationships with hospitals, and innovative research and development. Medtronic's case really highlights the importance of diversification and innovation in building a durable business. Their focus on constantly developing new, life-saving technologies allows them to maintain their market leadership and drive consistent growth.
So we've got Kiplinger with their focus on individual company stories, and Morningstar bringing in this concept of economic moats. But what does it all mean for you when you're actually trying to build a dividend-focused portfolio?
That's the million-dollar question, and it's where things get really interesting. Despite their different approaches, both sources are highlighting the same fundamental principle: sustainable dividend growth. Kiplinger shows us this through compelling narratives, illustrating how different companies achieve that growth. Morningstar provides a framework for assessing a company's long-term competitive advantage, which is crucial for determining whether that dividend growth is truly sustainable. So it's not just about chasing the highest yield. It's about finding companies that can keep those dividends flowing
Yep.
year after year, even when the market throws a curveball.
Right.
Exactly. That's why I believe Morningstar's emphasis on economic moats is so valuable. It adds that extra layer of analysis that helps us separate the companies that are built to last from those that might struggle in the long run.
Okay. So how do we...
It's like looking under the hood of a car before you buy it. You want to make sure the engine is in good shape and can handle the miles ahead.
That's a great analogy.
And it highlights the importance of doing your due diligence. Don't just rely on surface-level metrics like dividend yield. Dig deeper, understand the business, and assess its long-term prospects.
Absolutely. And remember, if you're looking for more insights on dividend investing and other financial topics, don't forget to subscribe to the AI Finance Podcast YouTube channel.
Yes.
We've got a ton of great content to help you build your wealth and achieve your financial goals. So what are your initial thoughts on these different approaches? What stands out to you as we start to think about building a dividend portfolio?
Well, I think
Now let's dive into some specific companies that caught our eye. From both Kiplinger and Morningstar.
Okay.
Kiplinger's list is packed with intriguing dividend growers, and one that really stood out to me was Realty Income, ticker symbol O.
Okay.
What's so cool about Realty Income is that they're a REIT, which means they own and manage income-producing real estate.
Right.
But here's the kicker. They pay dividends monthly, not quarterly like most companies.
That's right. For investors who rely on dividend income for living expenses or reinvestment, that monthly payout can be a real game changer. It's like having a reliable paycheck coming in every single month.
Yeah, I like that.
And their track record is impressive. They've been increasing those monthly dividends for 32 years straight.
Wow, that's consistent.
That consistency is really a testament to their business model. REITs are required to distribute a large portion of their income to shareholders. So consistent dividend growth from a REIT like Realty Income indicates they're consistently finding and managing profitable properties.
That makes sense.
Their portfolio is also incredibly diversified. They own over 15,450 properties across a wide range of industries. So even if one sector takes a hit, they're not overly exposed.
Right.
Exactly. That diversification helps mitigate risk and provides a level of stability that's really attractive for income-focused investors.
For sure. Another company that caught my attention on Kiplinger's list was McCormick & Company, ticker symbol MKC.
Okay.
You might know them for their spices.
Yeah.
But they've expanded way beyond that through strategic acquisitions.
It's a great example of how a company can leverage M&A to fuel growth and create value for shareholders.
Yeah.
They've been growing their dividend for 38 years. And a big part of that success comes from their ability to identify and acquire companies that complement their existing portfolio.
So they're not just like randomly buying up whatever they can, right?
It's not just about buying anything that comes their way. It's about finding those strategic fits that create synergies
Yeah.
and unlock new opportunities.
I see.
Precisely. And what I find particularly impressive about McCormick is that they're not just focused on expanding their product offerings.
Okay.
They're also investing in innovation, developing new flavors and products that cater to evolving consumer tastes. That forward-thinking approach bodes well for their long-term growth potential.
That's smart. Now let's shift gears and talk about Caterpillar, ticker symbol CAT.
Okay.
As we mentioned earlier, they're a cyclical stock, meaning their performance is closely tied to the overall economy.
Right.
But even with those ups and downs, they've managed to increase their dividend for 30 years straight.
That's a testament to their strong market position, their cost management discipline, and their unwavering commitment to rewarding shareholders.
Wow.
They've been through multiple economic cycles, and they've consistently come out on top. It's like they've got this massive bulldozer pushing through those economic obstacles and paving the way for continued dividend growth.
I like that analogy.
It really captures their resilience and determination. Now let's switch over to Morningstar's picks, which bring in that economic moat element we talked about earlier.
Okay.
One company that exemplifies this is ExxonMobil, ticker symbol XOM.
Exxon. Okay.
While some energy giants are going all in on renewables, ExxonMobil is doubling down on oil and gas.
Interesting.
It's a bold strategy, and it's certainly not without its risks. But Morningstar sees potential in their approach, particularly given their vast resources, their operational efficiency, and their experience in navigating the complexities of the energy market. They also point out that the transition to renewable energy is going to take time, and demand for oil and gas is likely to remain strong for the foreseeable future.
Yeah, that's true. That's true. It's not going to happen overnight.
That's a crucial point. It's easy to get caught up in the hype surrounding renewables. But we need to remember that the energy landscape is evolving gradually. There's still a significant role for traditional energy sources like oil and gas, and companies like ExxonMobil are well positioned to capitalize on that continued demand.
Okay.
Another interesting pick from Morningstar is Altria, ticker symbol MO.
Okay.
They're the tobacco giant with the highest yield on Morningstar's list. And while their industry faces significant challenges, they've shown incredible ability to adapt and generate consistent profits.
Yeah.
Right. Altria has been incredibly successful at managing their brand portfolio, navigating regulatory hurdles, and adapting to changing consumer preferences.
They've had to.
They've also been investing in new product categories like smokeless tobacco and vaping products to diversify their revenue streams. That adaptability is a key reason why they've been able to maintain their profitability and reward shareholders consistently.
Makes sense.
And finally, we have Medtronic, ticker symbol MDT. They're a medical device maker with a wide economic moat, stemming from their diversified product portfolio, their strong relationships with hospitals, and their innovative research and development. Medtronic is a great example of a company that's leveraging its expertise and resources to address critical healthcare needs. They're constantly innovating, developing new technologies and therapies that improve patient outcomes and drive long-term growth. Their commitment to research and development is a major factor in their wide economic moat.
That sounds like it.
So we've looked at companies from various sectors, each with its own approach to dividend growth and its own set of opportunities and challenges.
Right.
But one common thread running through all of these companies is their commitment to rewarding shareholders over the long term. That's what makes dividend investing so compelling. You're not just buying a piece of a company. You're partnering with a business that values its investors and shares in its success.
Yeah.
And it's a great reminder that building wealth is about more than just chasing short-term gains. It's about finding those companies that are built to last and partnering with them for the long haul.
Absolutely. Speaking of finding great companies, if you're enjoying this deep dive and want even more insights on dividend investing and other financial topics, be sure to subscribe to the AI Finance Podcast YouTube channel. We're constantly putting out new content to help you navigate the complex world of finance and achieve your financial goals.
We are.
So what are your thoughts on these specific companies? Are there any that stand out to you as particularly compelling?
Well, I think...
So we've explored the appeal of dividend growth. We've examined different approaches to finding these gems, and we've even met some standout performers in the dividend world.
It's been quite a journey.
But now comes the exciting part. How can you actually use this knowledge to build a dividend-focused portfolio that aligns with your personal goals and risk tolerance?
That's the key question, isn't it? There's no one-size-fits-all answer. But there are some guiding principles that can help you create a portfolio that's right for you.
Okay, what are some of those?
First and foremost, diversification is key. Don't put all your eggs in one basket, or even one sector. Spreading your investments across different industries helps reduce risk and protect your portfolio from downturns in any one area.
Right, so don't just buy all tech stocks or all energy stocks. Spread it out.
That's right. Think of it like building a house. You wouldn't want to build it on just one pillar. You'd want a strong foundation with multiple supports.
That makes sense.
Your time horizon is also crucial. If you're investing for the long haul, you can be a bit more patient and focus on companies with solid growth prospects. But if you need income now, you might prioritize those higher-yielding, more established companies.
Okay.
And don't forget about valuation. Even a great company can be a bad investment if you pay too much for it. That's where those Morningstar ratings can be really helpful. They can help you identify companies that are trading at a discount to their intrinsic value.
Gotcha.
And speaking of safety, always remember to do your own due diligence. Don't just blindly follow recommendations, even ours.
Yeah, always good advice.
Dig into those company financials, read analyst reports, and get a feel for the business before investing your hard-earned money.
Wise words.
Investing is a personal journey. Take the time to understand the companies you're considering and make sure they align with your investment philosophy. And finally, remember that dividend investing is a long game. Don't get discouraged if your portfolio doesn't shoot up overnight. The power of compounding takes time to work its magic. Be patient, stay consistent with your investments, and let those dividends snowball over time.
Right. Let it grow, let it grow.
That's the beauty of dividend investing. It's a strategy that rewards patience and discipline.
I like it. So to recap, find companies with sustainable dividend growth. Diversify across different sectors. Consider your time horizon and risk tolerance. Pay attention to valuation, do your research, and be patient.
Those are the building blocks of a successful dividend portfolio.
I love it. I love it. Now for final thought that will leave you pondering the possibilities. Now that you understand the basics, how can you go beyond just picking individual stocks?
Think about incorporating ETFs, DRPs, or even building your own customized dividend index. The possibilities are endless.
I love that challenge. It's all about empowering you to take control of your financial future and create a portfolio that reflects your unique goals and aspirations.
Exactly.
And speaking of empowerment, don't forget to subscribe to the AI Finance Podcast YouTube channel for even more financial wisdom. We've got a treasure trove of videos waiting to be discovered.
We do.
We're passionate about helping you navigate the complex world of finance and achieve your financial goals. So hit that subscribe button, join our community, and let's build a brighter financial future together.
Thanks for joining us on this incredible deep dive into dividend stocks.
It's been a pleasure sharing our insights with you.
Until next time, happy investing and stay tuned for our next video.